Okay. All right. So we'll get started here. Well, welcome to everyone. Thanks for tuning in. Although we've done a lot of Zoom calls over the last year, more than we'd all like to admit, this is the first webinar like this that we put together. We've shared a few from other experts from Raymond James and some other places, but this is our first crack at it. So we appreciate you tuning in, and we're excited about our discussion today. And we thought we would structure this a little differently than maybe some of the other webinars that at least we've seen. Maybe you've tuned into some. We wanted this to be more of a discussion, more like a fireside chat. And so we set it up that way, and we've asked you as you RSVP to submit any questions that you might have. And thank you. We did get several of those, and that's certainly helpful. So we'll get started here, and I wanted to introduce the other advisors that we have here on the call. For those of you who don't know me, my name is Todd Wyke. I'm the branch manager here with the Potomac Financial Group, and we have several other advisors from our office here. So as I mention your name, maybe you can just give a little wave to the camera, and we'll go through the list here. It looks like we're missing one or two. I think we've had some technical difficulties, but we'll see if we can get them on here in a bit. First, we have Brad Shell. Brad, there you go. Chris Heald. Oh, Chris. Lanta Evans. Brian Kroick. And Jeremy Dvorak. And Deb Kelly is also, we're trying to have her join here. Like I said, we're having some issues with that, but hopefully she'll be able to join us here soon. So we'll be here to have our discussion with Steve Chiavarone. Steve is from a firm called Federated Hermes, or Hermes. I don't know if I'm saying that correct, but we've known him for a long time.
Hermes, like the god.
Okay, we've known them for a long time just as Federated, but they recently acquired another firm called Hermes. And so Federated has been a wonderful partner of ours, a wonderful partner of Raymond James for a long time. Many of you may recognize the name just from the mutual fund strategies that we have in a lot of our portfolios. And we were very excited when Steve offered to help us with this call and join us for this call. Steve is an equity strategist and a portfolio manager for Federated. He's been with the firm since 2007. I've seen Steve speak at numerous conferences, usually in front of a packed house, and I always leave his sessions just feeling like I really learned something. I think Steve has a very good knack for explaining complex issues in a very understandable way, and so that's what excited us about having him available for us today. So. Like I said, we have a number of questions prepared for him. It's going to be more of a discussion format. Unfortunately, we're not able to have a live question and answer session due to compliance reasons. So if any questions do come up, please just jot them down and shoot us an email. We're happy to have a phone call with you afterwards. And if it's something that we can't answer, I'm sure we can get in touch with Steve pretty easily and have him help us with that. So. As I was talking there, I did notice that Deb Kelly was able to join us. So hi, Deb, glad you made it. And so with that, we'll get started here, Steve. So first question I had, you probably have heard this a lot, and I know many of our clients have heard us say it, but the old saying that the market climbs a wall of worry. And I don't know if there's ever been a better example of that than what we experienced in 2020. And now that we have a lot more clarity on the major issues that we were worried about last year, what do you expect to see with the markets as we go through 2021? And of those issues that we were very worried about, what are you still worried about as we go through the year?
That's a great question. Thank you, everyone, for having me. Try to do our best here today to be somewhat entertaining. Look, there obviously was a huge wall of worry last year. You had the recession, you had the pandemic, you had the elections. I think the first thing that frustrated a lot of market participants last year, as is normally the case at a market bottom, is the market doesn't wait for the economy to go from bad to good in order for the market to start to respond. The market tends to bottom and move higher when the economy goes from putrid to just awful. And that's what it did back in last March. And so we've been in a period where I think the markets have been running ahead of the economy. The markets see that the economy is recovering. They see that the pandemic, will have some end date to it, and the markets price that in. I think we are likely. So as you look at the world right now, it appears as though there is no more wall of worry, right? The election's settled, stimulus is coming, everything's going to be great. Well, we're going to create a new wall of worry because that's what we do. And you're starting to see the formation of that wall of worry already. And I know that there's some questions that are coming in a second, but there's going to be a wall of worry around inflation. And there's going to be a wall of worry around interest rates. And there's going to be a wall of worry built on what happens when you get widespread vaccination and the first economic data point misses. And there'll be a wall of worry around some policy proposals that are likely to come after we've done this next round of fiscal stimulus. And so what I think we're most likely in store for is it's very hard for market participants to sell or get bearish ahead of widespread vaccination and the Biden, $1.9 trillion fiscal stimulus. Once that happens, though, and that's going to be in the next several weeks, I think you can get a period where the economy runs ahead of the markets, where the market looks out and says, oh, wait a second, vaccinations are occurring, but things aren't turning on just like that. Maybe they're taking a little while to ramp up. And, oh, 10-year yields at 1.3%, and some of the inflation measures look a little higher, and then having some concerns there. And then in addition, once fiscal stimulus is done, the next big recovery act that they're calling it is going to include infrastructure, Obamacare reforms, and tax increases. So nobody wants to hear the tax increase word. And so you'll have some concern around that. And so I think you'll have a kind of period in the middle of the year where you might see a little bit of the markets underperforming the economy. Ultimately, and we can get into this in more detail, I think those inflation concerns are going to be way overblown. The Fed's not going to bite. The Fed's going to maintain its dovishness and keep control of longer-term rates. I think that the policy proposals that will ultimately be passed, given the configuration of Washington, are not going to be extreme because they can't be, because they got to get past Joe Manchin, for lack of a better term. Probably could throw Kristen Sinema in that group as well. And I think that you are going to see a lot of pent-up demand, which we saw in this morning's retail sales number, which was through the roof, really come through and have an economy that does well. So I think you're likely to see, we've kind of passed a wall of worry. The market's allowing itself to get a little bit euphoric in pockets. That'll get crushed over the next couple of months. We'll all be dour and then the market will move higher. I'd also say that I think in as positive as the market outlook has become in the recent weeks, if you don't have a double dip recession, right? And we just had a recession and we're in recovery now. If you don't have a double dip recession, and those are exceedingly rare and almost always caused on purpose, believe it or not. The shortest economic recoveries and expansions are 5 to 7 year events. I don't think the market has allowed itself to even entertain the idea that we're in the beginning of a multi-year economic recovery and expansion. And so I think that's an area where I think maybe the market isn't optimistic enough. If that's possible right now. So that's kind of our thoughts about how that works out. Ultimately, as long as the economy is recovering, earnings are recovering, and again, this is a broad-based economic recovery right now. We think the risks are to the upside, but we would not be surprised to get a little bit of a period of weakness here in the middle of the year.
Thanks, Steve. You alluded to this somewhat just now, but one of the most common questions we get from clients is, isn't the market really high right now? With the underlying assumption being that it must come down. We know you have a positive outlook for the markets this year. We've seen the data that you have to back that up. For our clients who just want kind of the Cliff Notes version, can you give us your thoughts on why these market highs shouldn't be a cause for concern all by themselves?
Sure. This one's a real pet peeve of mine because there's a closet industry of Wall Street types that have scared people out of fortunes by telling them that the market is expensive every 2 seconds. It is true that since 1960, on average, we pay $14.50 for every $1 of company profit. That's the average PE multiple since 1960. It is also true that today we're paying $22 for every dollar of company profit. 22 is greater than 14.5, therefore we are expensive. That is technically true. It is also technically true that a tomato is a fruit. I don't want it in my fruit salad. So you have to bring some context to that. So why is the average $14.50? because for 20 years, you could go and buy a United States Treasury bond backed by the full taxing power of the government that has an army, and it would pay you between 10 and 15%. Or you could buy a risky stock and get paid 10%. So let me get this straight. I could take risk and make 10%, or I could take no risk and make 10 to 15%. Gee, what do you think I'll do? So between 1972 and 1992, we paid very, very little for stocks, between 5 and 10 times on average. That universe doesn't exist. The only bond that you could buy that would give you 10 to 15% interest, you don't want to own, because there's an extraordinary chance that you're going to get nothing on that bond today. If you can get 2% on a bond, dance the jig. So now all of a sudden, what am I willing to pay for a stock when I'm only getting 2%? Or, you know, in the case of the United States Treasury, we're excited because you can get 1.3%. Wow, right? So when you look, so there's this relationship between what a bond yield is and what we pay for stocks. When you look at a period of time where bond yields are low, what's the average we pay for stocks? Well, now it's closer to 19 times. So all of a sudden, I'm not ridiculously expensive. Now, let's take it a step further. What have I paid for stocks when bond yields are this low? Trick question. They've never been this low. Ever. In the history of bonds, have you had the corporate bond yield this low relative to stocks? So when you look at where the bond yield are, it would suggest that this market could trade at 28 or 29 times earnings instead of the 22 that we're at. In fact, we're trading about 4.5. We pay $4.5 less per dollar of earnings than bond yields suggest that we should. That's one of the biggest gaps ever. So are we expensive or are we cheap? Right? Here's what it comes down to. And this is why I think it's very, very interesting. A bear will tell you, be careful, markets are expensive, the odds are not in your favor. Okay. Market multiples expand on average 2 turns when an economy is in recovery, meaning that it gets more expensive, not less. So if you think you're going to have a major fall off a cliff, that's arguing against history, not arguing that it's going to get more expensive. When interest rates are low, you pay more for the market. That's consistent with history. When earnings are growing at 20 to 25%, you tend to pay more for the market. That's what's consistent with history. So, you know, are there pockets of fraud? Sure there are. Sure there are. There are certainly parts of the market that are overextended. But broadly speaking, when you look at the overall market, it's pricing very, very rationally. It's pricing, in fact, cheaper than bond yields say that it should. If anything looks excessively expensive versus its history, it's bond yields, not equity multiples. You know, I'd also say this, for all the concern that's out there, here's a very, very simple study. 1929, somebody puts $100,000 in the S&P 500, 2 people. One person does nothing for 90 years. The other person buys $1,000 a month. You can imagine that between 1999 and 2029, 2019, there were a lot of times where you were putting that $1,000 a month in at an all-time high, right? Because markets trended up. The person who did nothing earned a 13,000% return over 90 years. The person who put $1,000 a month earned an 82,000% return and outperformed in the 30s, 40s, 50s, 60s, 70s, 80s, 90s, and 2010s. 8 out of 9 decades. So if you've got a long-term time horizon, who cares? Average in. Don't try to pick the top. Don't try to pick the bottom. Don't assume that you know. 1987, the market was 7 years away from its last recession. It was at an all-time high. It fell 35% over the course of a month and a half and rebounded quickly within a year. And you know what it went on to do? It hit new highs for another 12 years. That can happen. You don't know. Don't try to play that game. It's a sucker's game.
Steve, I have a follow-up question to that. You just talked about interest rates being at historic lows, which means they are going to need to rise at some point. So we have a lot of clients who are complaining that for the money that they have sitting in cash that possibly should be part of their specific asset allocation to cash. What advice would you give those individuals who are concerned that their cash isn't making any return because rates are so low?
Yeah, I think this is a great question on a number of fronts, and I'll kind of level set on a couple. Number one, inflation will be the battleground. Inflation and interest rates, I think, are, by the way, if you notice my kids running up and down, they got home from school at 3. I would apologize, but I'm sure you're all dealing with the same thing. So I like to think that it makes me relatable and charming, but if not, just let me know and I'll yell at them. Interest rates and inflation are going to be the battleground over which bulls and bears will fight. Let me start there. And one ties to the other. Rates go up when you think inflation is going to go higher. There's 2 reasons why I think the market's going to be head faked on inflation, or a couple of reasons, and I don't think it's real. And so I think you're likely to see a reasonable move higher in rates, one that is enough higher that actually pressures bond returns, but not some kind of catastrophic bond cliff. Remember this, we haven't really had inflation since the 90s. And even then, it wasn't all that grand. So most people that are in Wall Street have never actually experienced inflation. And so guess what happens? Definitions get lost. So what is and what is not inflation? Inflation is not simply an increase in prices, or a jump in prices, or a spike in prices. Inflation is a persistent, accelerating upward pressure in prices that erodes the buying power of your money. It has to be consistent and repeatable. Prices just jump once, we all adjust, that's fine. So we're going to see price shocks this year. I will bet my bottom dollar on it that we're going to see price shocks. You saw what I did there. See how quickly I did that? Good,
You're
right?
good.
That was good. It's like I didn't even miss a beat in the sentence. We will see price shocks. Let's talk about one. Bruce Springsteen is going to announce on July 4th at 10 a.m. when the pandemic is over, and I'm obviously exaggerating to prove a point, that he's going to have a concert at the Stone Pony in New Jersey. And everyone in New Jersey is going to want to go because it's the boss. So what's going to happen? Those tickets are going to sell out within 30 seconds. They're going to go on StubHub and they're going to go through the roof, right? It's going to be $1,000 to get a nosebleed seat to see the boss on July 4th because we haven't been able to leave our house for 2 years. That's not inflation. Why is it not inflation? Because after he has that concert, he's going to announce the Bruce Springsteen post-COVID comeback tour with 15 dates. And so all of a sudden, we're going to know that we're going to be able to go, supply demand will come back into balance and prices will normalize. That's going to happen in hotel rooms. It's going to happen at Disney World, at Vegas. It's going to happen with oil and gas because last year we didn't do oily things. We didn't fly places. We didn't drive places. This year, I want to do every oily thing. I want to fly everywhere. I want to go everywhere. I want to go out to dinner. I want somebody to clean up my plate that isn't me or my wife after I eat, right? So we're going to do all kinds of oily things, but we've just cut oil production because prices were zero last year, right? So you're going to have these shocks that are going to occur, not inflation, because they're not repeatable. They'll settle back down. In addition, we're going to get some weird math, or as George W. Bush used to call it, fuzzy math. What's fuzzy math? Energy prices, oil prices might have been $50 2 years ago. Last year, we know that for a couple of days, they went negative. This year, let's say they go back up to $50 a barrel. So when I report the year-over-year price increase, it's going to have gone from 0 to 50. That's an infinite price increase. Inflation of infinite proportions. All I did was go back to where I was before. So you're going to have that base effect that's going to kind of scare people. So you're going to get a scare on the Bruce Springsteen price shocks, and you're going to get a scare on the infinite percentage inflation. That's not inflation. And the Fed, we think, is going to work us through that. We'll talk about that in a second. In terms of interest rates, they're going to rise, and they have because growth expectations are better and those inflation expectations are better. But here's the thing. The Fed doesn't want them to go too high because if interest rates go too high too fast, it'll imperil the recovery. So at first, they're going to tell us nicely, don't worry about this. It's not inflation. They'll say things like transitory, temporary, supply-demand imbalances. If we don't get the message, then they're going to say, we're going to do Operation Twist, and we're going to do more buying of 10-year bonds. In other words, Stop making bonds go up. We don't want them to. And if we still don't get the hint, Jerome Powell's going to rip his shirt off, flex his muscles, and say, I own 40% of all outstanding US debt. I will buy an unlimited amount of 10-year treasuries until interest rates fall below X percent. Try me if you think you can beat me on this. That's yield curve control, and he will win. So we think rates are biased higher, but really no more than 1.5%. Now, in that environment, though, your bonds can lose money, depending on where you are in your bonds. One of the biggest risks out there for investors is doing stupid things in order to try to get yield. The first thing you have to keep in your mind is there is no risk-free yield available. There is no risk-free income. You either have to accept lower income or take on risk to get yield. So the first question you ask yourself is, why do you own bonds? If you own bonds because in an event like what happened last year, you want something that doesn't fall when equities fall, you want to hedge, they're fine. You've got enough yield as they are now, and they're a good downside protection. If you're holding them because you need income, they're not fine, and you need to find that income elsewhere. Now, what are the kind of risks that are prudent to take? Risks that you understand. So you can go from your treasury bond out to a corporate bond, get a little bit more yield. Not a lot, but a little bit. You can go out to a high yield bond. You're going to take a little more risk. You're going to get a little bit more yield. You can go to an emerging market bond, even more risk, but more yield. Or you can go to dividend paying stocks. No longer a bond, a little bit more risk, a little bit more yield. In an environment where you think bonds are actually going to go down, then guess what? Cash doesn't look all that bad, nor do short duration investments, because they don't fall. They're going to stay flat. And sometimes zero is better than down. So within our portfolios, if you were to ask us, would we rather have a 10-year treasury bond or cash? I'd rather have cash. And so that's part of the balancing act here. What's the right mix? The right mix is whatever you're going to stick with and not get spooked out of the market. That's the right mix. And so, we think that part of the story here is owning a little bit more shorter duration, things like ultra shorts, micro shorts, cash assets, but also on the other side, barbelling out and going out the risk curve to high yield and dividend paying stocks. I know that was a really long-winded answer, but I thought that was a really important question. So I hope it wasn't too long. All right, who's next?
I think Brad, are you available?
I'll go.
There you go.
Steve, got a question on international stocks. For so long, we've been hearing about, folks sort of having a home country bias and, being unwilling to go that route. They've underperformed the U.S. markets for a long time, and just curious what your thoughts are about going outside the borders.
Yeah, there's been an obsession on Wall Street to want to favor international stocks over domestic for the last 10 years. And for 10 years, it's been wrong. And so there's a couple there's a couple consequences of that. It means that there's a lot of clients out there that don't want to hear it again and don't want to take the bet and don't want to give it a try. I think it might be a little different this time. We have not been one of those firms that have called for international over the last 10 years. We've been consistently overweight the U.S. But let me walk you through how we view it, and then you all can make your own decisions. To us, international versus domestic is no different than growth versus value. So if you think that growth and the FANG names are going to lead the market, you should not be overweight international. If you think that there's a chance that they won't be, then you should. And here's why I say that. If you look at the MSCI World ex-US, so every developed country in the world that's not the United States, and you look at their index, their stock market, and what weight is in each sector versus the S&P 500, here's what you'll find. They have 8% more financials, 7% more industrials, 6% more materials, 4% more staples, 1.5% more energy, 1% more utilities, and 0.5% more real estate. Every value sector they have more of. What do they have less of? 1.5% less consumer companies, 2% less healthcare, 6% less comm services, which includes Facebook and those kind of companies, and 18.5% less tech. Tech runs, they don't work. Now, we think that value will outperform this year, and therefore we think international will also. Why do we think that? So think about Netflix and Marriott. Anyone here watch this show, Bridgerton? All right, I watched one episode of this thing, Bridgerton. I hate it. I hate it. I despise it. But I watched it. You know why I watched it? Because I'm stuck at freaking home. And I've watched every other thing there is to watch on TV. And my wife said, let's watch Bridgerton. So I watched Bridgerton. I can assure you that in a post-vaccination world where I have a life, I'm not watching Bridgerton. I will be drinking a bourbon, talking about how I will never want to watch Bridgerton ever again. So those companies, now I'm not going to cancel my Netflix, and nor is anybody else. But what I'm saying is that those big tech and growth companies went from excellent. They've got all of my attention because my life is on this thing right now, right? This is my entire existence. Next year, I don't think it will, or later this year, I don't think it will be. They're going from excellent to just great. You know, another way of thinking about it is last April, everything I bought from Amazon because it was the only store with which I could legally do business. Now, during Black Friday, yeah, the delivery guy was sleeping on my porch, but it wasn't the only place I bought things from. On the flip side, I may have spent 90 nights in a Marriott in 2019. Last year, I may have spent 10. Maybe this year I'll spend 30. 30 is still a third of a normal year, but it's 3 times better than last year. So it's going from awful to just bad. The market has a tendency to punish excellent becoming good and reward awful becoming bad. Since Labor Day, value has outperformed growth by over 10%. If you play that out over a full year, that's 30% outperformance. So if value runs, international is going to run. And I will say this, 2021 in our mind is a much safer year from an absolute return. You're much less likely in our mind to lose money, but it's a much more dangerous year from a relative return perspective. You're much more likely to underperform the market this year because we don't think that growth is going to roll over and die. There's nothing wrong with it. It's not going to fall 20%. And so if you are dominated in the US and dominated in growth stocks and dominated in big companies, you'll be up 3 or 4%. But the market could be up 15 and value and international and small caps could be up 25, and you're going to feel like you really missed out. And you can say that that won't bother you ahead of time. It'll bother you in the moment. And so what would we suggest you do in international? Look, do I think you should be massively overweight? No. But if you're really underweight, should you close some of that? Yes. The only thing to watch, that's a caveat to what I just said, there were 2 legs to our overweight international stool. One was everything I just talked about. The second one is we thought the dollar could weaken. If Democrats in Washington spend more than the Germans, the dollar should weaken, and that makes international assets more attractive. However, there's a problem. No one in the world has a vaccine that's as good as ours. The Moderna and the Pfizer vaccines are altogether better than anything anyone else has because they're the mRNA vaccines. So they are just about as effective against the variants as they are the standard COVID, where a lot of the other ones like AstraZeneca, Novavax, and Johnson & Johnson are not. And so the dollar has been rallying because we're better on that front. And that may stunt some of that dollar weakness and make international attractive, but maybe not as attractive as it would have been otherwise.
Thanks, Steve. So there's a lot of proposals for additional spending and additional or increased taxes. Can you highlight which of these we should expect to see in the next year or so, and
Yes.
how they could affect the market, the stock and bond markets, please?
So, you know, I think one thing to keep in mind is, it's going to sound crazy. There is no need to increase taxes or cut spending in the short run. I know that sounds insane. And I know that it goes against everything my father and grandfather and mother and grandmother would have told me, but let me walk you through it. In 1990, our federally held debt to GDP was 50%. In other words, all the debt that we had as a government was 1/2 of 1 year's worth of income. So think about it as having a $200,000 a year income, and $100,000 mortgage. And pretty good, not bad, right? In 2019, it was 100% of GDP. So on that same 200,000, you got a $200,000 mortgage. By the way, again, not all that terrible. By 2024, it'll be probably about 150% of GDP. So $300,000 mortgage on a $200,000. However, what people don't tell you when they talk about that debt problem is what our interest payments have done. So when it was 50% of GDP in 1990, we paid almost 5% of our yearly income towards interest payments. Today, that's more like 2.5%. In fact, in the history of the Republic, outside of the brief period of time under Andrew Jackson when we extinguished the federal debt, I don't think we've ever paid less than 2.5% in interest. Why? Because the debt we were issuing in 1990 had a 10 to 15% interest rate, and the debt we issue today has a 1% interest rate. Think about it this way. I don't even blink twice at having a larger mortgage than my parents because I borrow at 2.75 and they borrowed at 20% in the 80s, right? That's normal. And we see that through the economy. So there is no immediate need to raise taxes in order to fund it. There simply is not. Will you see tax increases? Will you see regulation? Yes. The incoming administration and the Democratic majorities are not looking to raise taxes for fiscal reasons. They're looking to do it for distribution reasons. They think that certain people should pay more and certain people should get more in services. Now, we can argue, between now and the end of days, whether or not that's right or wrong, doesn't really matter. It is. That's how they view it. So tax increases on certain portions of the population are a big part of their agenda. Now, what's important to remember, though, is that those tax increases are not coming in isolation. They're coming paired with stimulus measures. So, for example, Joe Biden's tax plan during the campaign was $2.2 trillion of tax increases, which, in and of itself, is the largest tax increase since Lyndon Johnson in 1968. However, we just spent $3 trillion, right? We had the $1 trillion deal in December. We're doing $2 trillion now. And the infrastructure plan that he's likely to pair with that tax increase is probably going to be somewhere in the 3 to 4 trillion. So you can't just look at it in isolation. So how do you think about it? Is it likely? Yeah, look, you have a Democratic administration with a unified Democratic government. They're going to get some tax increases through. There are going to be some regulation. You should expect, I know this is difficult, but expect a Democratic administration to, be Democrats. The question is how extreme is that going to be relative to what normal policy swings we normally see? I don't think it's going to be that extreme because I don't think it can be. They've got to maintain the 51 votes. They need every Democrat to vote at a minimum for everything they want to do, right? And if it's not done through reconciliation, they then need 9 Republicans. Well, I got a better chance of slam dunking in the NBA than them getting 9 Republicans on anything extreme. If you can't tell from the video, I'm not tall. And some of those Democrats are very moderate. I don't know, you could be very moderate, but they are very moderate, right? Joe Manchin is a self-proclaimed conservative Democrat. Kristen Sinema is in a very similar position. And so I think, what are you likely to get? Tax increases, yes, but not as draconian as what you saw in the Biden campaign plan. So maybe you take the corporate rate from 21 to 25, but not to 28. Maybe, for example, you don't get a doubling of the capital gains rate on incomes over $1 million. That may be too difficult to do. You probably don't get Social Security taxes levied on earnings over $400,000, but you probably do get an increase in the top marginal rate from 37 to 39. Maybe that's paired with the return of the SALT deduction. So again, I think you are likely to see increased regulation. You're likely to see increased taxes. I don't think they're likely to be extreme. Ultimately, think about the economy recovering as the Titanic and changes in tax policy as a raft. You're not going to turn that ship around. The economy is recovering. Now, can those tax policies and regulations speed the recovery or slow it? Yeah, marginally, but the recovery is happening one way or another. Can it make certain parts of the market more advantaged than others? Yes. You increase the corporate tax rate, it's going to hurt tech the most. because a lot of tech companies don't pay any federal income tax. You institute a corporate minimum tax, we're going to get hit the most. You increase capital gains rate, people are going to sell their tech companies because that's where all their capital gains are. So that might benefit value over growth. I mean, there's those kinds of considerations. But the idea that you should sell and take your ball and go home, history would be very strongly against that argument. In fact, it's never worked. So I wouldn't play that game. Where I would get more concerned is if you saw things like the elimination of the filibuster and the packing of courts. Then I think it's harder for individuals and businesses to plan because you're subject to more extreme shifts in policy that can happen more quickly. I think then you're going to have a little bit of retrenchment in investing and spending, but I don't think that's likely to happen.
Great. Thanks, Steve.
Yeah, I think I'm up next. Yep.
Yeah, jump in.
First of all, I apologize for the technical difficulties. Typical of me, though. Anyhow, I wanted to talk about the real estate markets.
Yeah.
The residential real estate markets, we've seen it on fire lately. Houses have been flying off the shelves. Prices have gone up. But many are concerned about the future of the corporate office real estate now that companies have realized that working remotely can be effective. Look at us all right now. I think we're all sitting, well, most of us are sitting in their home offices. So what are your thoughts on the real estate boom we've been seeing from a real estate perspective? And then also, will the corporate office real estate struggles, will they be enough to create bigger problems for our economy?
Great question. So let's start on the residential side. One of the things that we've been predicting for a while, and I feel robbed because I can't know now, is that we thought for a long time, starting in 2020, you would see a residential real estate boom. There are 92 million millennials in the United States, 60% of which were under the age of 30 coming into this year. And the greatest determinant over whether or not someone historically wants to live in a single family residence is not income, down payment, wealth, color, race, creed, gender. It's whether or not you have a child. The moment you have a child, you're more likely to want to be in a single family home because of space. You don't want your neighbors getting upset, and schools tend to be better in places where you have single family residents. And so we had long predicted that would be the case. Now, obviously, you've seen a boom in single family real estate. It has been driven by millennials, but there's no way of knowing how much of that is just because of the pandemic or what would have happened otherwise. We don't know if it was pulled forward or accelerated or if it would have happened. Either way, it's happening. The point is, I still have 62% of a 92 million person generation that's likely to want single family homes. And we expect that to continue. So that's number one. Number two, the more and more you have a scenario where you can work from home, the more and more single family homes in suburbs and exurbs become attractive, right? So when I bought this house that I bought in March, one of my requirements was that it was within a certain distance to the train station. I don't give a damn how far it is from a train station now. Unlikely to take that train on a daily basis. But again, in the extreme example, right, how many people were in apartments in Jersey City because they needed to be in New York that are now willing to come out and for the same monthly payment have 4,000 square feet instead of 400. And so I think that that's a trend that's likely to continue. And we have underbuilt housing in this country for a decade because home formation was lower than you would have expected. And I don't think we're going to go back. So I think that there is a good underpinning behind the residential real estate market, one that is backed by demographics that we think would have taken place anyway, but has obviously been accelerated by what's going on. On the commercial front, remember, there's not just one commercial real estate. There's all different kinds of commercial real estate. So let's look at them in different tranches. Is there any reason to think that commercial real estate around cell towers and warehouses and distribution is going to do anything but better? No, that's going to be an area of strength as we do more online commerce, et cetera, et cetera. Let's look at restaurants and stores. Well, yeah, there's going to be less urban, but there's going to have to be more suburban. I still want to eat. I'm just not going to eat in the city. I'm going to eat in the suburbs. So I think you're likely to see some shifting there. In terms of retail space, we've been over retailed. If you look at the amount of retail square footage in the United States relative to any other country, we're something like 10 times as much. So we've had too much retail space to begin with, and that's been consolidating over years. Remember, we lived through in 2019 retail Mageddon, which keep that in the back of your mind. No, we'll talk about it right now. mass bankruptcy or the death of an industry or the sharp consolidation of an industry, when it takes place in an otherwise healthy economy with a healthy banking system, is not a risk. We've had more retail bankruptcies over the last 5 years, and those were some of the strongest economic and market years in record, because the banks were healthy, the economy was healthy, and it was absorbable. And in fact, despite retail-mageddon and record retail foreclosures, unemployment rate hit the lowest level in 50 years. The economy can absorb insolvency, bankruptcy, and default when it's strong. It can't do it all at once in a crisis. So even if the answer to your question is there's going to be a reckoning in commercial real estate, so long as it's occurring in an economy that is in recovery or growth with a strong banking system, that's fine. And I think we're already entering into that place. In terms of office, I think we have to rethink office, and it's going to be smaller and it's going to be cheaper. And there is going to be, landlords are going to have to accept lower rents, and there will be some people that won't survive it. I think where we're going to shift is the office from the home to the office as the hotel, right? In the world that existed before the pandemic, if I woke up on a day and wasn't traveling somewhere, I went to the office. Why? Because that was the default. It was my home. I had a dedicated space with my pictures on the wall, my shoes underneath. That was my home, right? I don't expect I'll go back to that. I expect I'll use it as a hotel. If I'm not, either I will work out of this home office or be on the road, but if I need to be in the city, then I will have an office that I can rent for whatever period of time I need to be there. In other words, if my boss is in town and he wants to see me, I'll be in the office that day. If I'm doing a media appearance and I'm going to be in the city anyway, I'll go to the office. I think that is going to be the model. Now, that doesn't necessarily mean, though, less real estate. I may end up having 3 places instead of 1. I might have a small satellite in Connecticut for the people that live there, small satellite in New Jersey for the people that live there, and a small office space in New York when we have to do third-party meetings. That could be a solution. We may also find out that over time, a lot of employees want to come back to the office. They don't have to, but they want to. And so I think it's too early to say that we're all going to stay home forever. I don't think that's right. I think it'll be more flexible. I don't think we necessarily have to have a room for every person to go into every single day, all day. But I think it's largely going to be okay. And banks and the Fed are not going to lose this recovery because we're not willing to deal with a couple of bad commercial real estate companies. I mean, we've come too far to allow that. So could it be a pocket? Do I want to own every REIT? No, I don't want to own every airline. Not all of them are going to survive. In fact, I don't want to own anything. I don't want to own a passive instrument that owns the entire benchmark because I don't care what part of the market you look at. Not all the kids are going to be okay. There's going to be winners and losers, and you're going to get paid right now more so than I think at any point in the last decade in choosing between the two.
I have another quick question.
Yep.
This one's about sustainable investing.
Yeah.
Investing in companies that adhere to the strict guidelines regarding environmental, social, and corporate governance. So ESG investing is becoming much more mainstream. And in fact, many of our clients have already been transitioning to the strategies. So what are your thoughts on ESG as a theme or a filter for investment portfolios? And do you see anything with this theme that should worry investors moving forward?
I'm a believer of the radical idea that a client's money is their money. And they get to do whatever they want to do with it. And it's our job to help them do that in the best possible way. So I start there. I also believe that we have a fiduciary responsibility. At least, I mean, I have a legal fiduciary responsibility in my role on the asset management side. Wealth management is a little different, but from a wealth management perspective, or asset management, to maximize a return at a given level of risk, right? That's what I am legally bound to do. Now, I also have a responsibility, though, to use every tool at my disposal in order to do that. And while most factors that, hold on, I think I'm freezing. You all still have me? Hold on, okay. Most factors that affect how a company does are on their balance sheet or in their income statement or traditional financial factors, but not all of them, right? If I were to look at a company like Boeing a couple of years ago, they had great financial results. They had a backlog of 100 years of orders, but there were some issues with that company that weren't in the financial statements around their quality control and their corporate culture, different things like that. I have a responsibility to look for those factors. So here's what I can do with ESG and here's what I can't. What I can never do with ESG is take someone's money and pursue my objectives and agenda. I have no right to do that. It's not my money. I have a responsibility, however, to look at E, S, and G factors to make sure that I'm giving that client the best chance of winning, i.e. getting the highest return for a given level of risk. And if I don't do that, I'm being derelict in my duty to the client. Further, as more people are interested in these factors and interested in making sure that they're investing in funding companies that they feel reflect their values, that's going to affect the price of those companies and those stocks, because it's fundamentally affecting the demand for those particular investment securities. So I think that it is a part of being a responsible, prudent manager at this point. And I think it needs to be built at some level into all investment strategies. Now, that doesn't mean that you're investing for a specific goal. Doesn't mean I'm saying that, hey, every portfolio needs to generate a certain climate outcome. No, what I'm saying is that insofar as investors care about the carbon footprint of a company, or how they treat their clients, or how they have representation on their boards, and that could affect the price, I need to account for that. Not because I think it's right, wrong, or indifferent, but because it's my job to maximize the return of a given level of risk. And so just making sure you all can still hear me, because I know I'm having some internet issues here. When you look at the survey data, and you look at particularly the millennial generation, there's something, and this really relates to women, and I've done a lot of research on this. The biggest concern for a millennial woman is whether or not she's going to, financial concern, is that she's going to run out of savings in retirement. If she's worried about running out of savings in retirement, in fact, 70% of millennial women are more worried about running out of savings than they are worried about their health in retirement. If that's her primary goal, here's the problem. She can't make her money any way she wants, spend it however she wants, grow it however she wants, and then do good at the end of her life through charitable giving, because she's concerned she's not going to have enough. And so her attitudes towards investing are very, very different. She wants to work for a company that she shares values with. She wants to buy products from companies that reflect her values. She wants to fund companies through her investments that reflect her values and allow her to have an impact on society, because she doesn't think she's going to have the opportunity to give it away. If that is going to permeate 70% of the population going forward, that is going to be the recipient of $30 trillion in wealth, I can't ignore it. Doesn't matter if I agree with it or disagree with it. It's irrelevant. I do agree with it, but it didn't matter if I did or didn't. It's their money. And so I think it's becoming, I think it's going to be very mainstream in the next 5 to 10 years. And I think what you have to be careful about, though, is because people know that 70% of the emerging client base wants this, there's a rush to say that they're ESG. Well, it better be real, and it better be authentic, and it better be with the client in mind, not using clients' money to pursue your own values or objectives. That we don't have authority to do that. So we're a big believer in it in terms of something that we need to account for. We are believers in letting each of our investment teams figure out how to authentically bring that into their investment process. And what it really comes down to is doing right by the client, trying to get the best return to give a level of risk. Now, last thing I'll say about it. If, however, you want to run your money in a manner that does drive a particular outcome, so isn't just better from an ESG perspective, but maybe impacts climate or some sustainability goal, we can do that. But that needs to be separate. That needs to be a different investment that has its own purpose, that isn't maximizing return to a given level of risk. And guess what? If you want to do that, it's your money. You get to do whatever you want to do with it. It's our job just to help you do it in as responsible a way as possible and making sure that you get the best outcomes. We don't get to tell you how you should, what your values should be. And I think for the folks that don't want to do this at all, you're in the business of doing that. for the folks that want to take other people's money and pursue their own goals. You're in the business of doing that. I think both of those are wrong. What you want is somebody who's a partner that says, insofar as this matters to you, can we carve out strategies that allow you to achieve your goals? And even if it doesn't matter to you, can we account for these factors that are becoming more important? Sometimes a job description is a good thing. You should just stick to it.
Great. Thanks, Steve. Switching gears a little bit, we're hearing and reading more about modern monetary theory. And I suspect we're going to hear a lot more about this as we go along. And I know this is a big topic and we could spend a lot of time talking about it, but can you explain to everyone, just give us maybe a summary of what this is and how you think about its impact on the markets? And is this a problem we need to be concerned about, or is this something we need to warn our children and grandchildren about?
I'm literally reading The Deficit Myth right now, which is the Bible on modern monetary theory. And I'll start by saying that I'm like in a schizophrenic mood. On the one hand, I am overjoyed by some of the myth busting that the modern monetary theorists do, because there's a lot of myths about how the federal deficit and debt work that are really wrong and dangerous to think about them that way. And then in the same breath, I want to throw the book on the ground, stomp on it, and set it on fire, because I think some of their policy prescriptions to those myths are worse than some of the things we do today. So here's what it is and here's what it isn't. What it basically says is that we should run fiscal policy the way we do monetary policy. That the goal is not to achieve a balanced budget, but to achieve whatever deficit gets you the closest to full employment without causing inflation. That's the basic tenet of it. That's why it's monetary theory. It also says that you shouldn't think about the government's finances the way you do household finances. That's true. The government is not a household, right? If you or I have a debt problem, what do? We've either got to cut our spending or increase our income, and then we won't have a debt problem. The problem is that, or the difference is our spending doesn't influence our income, and the way we influence our income doesn't further influence our income. In other words, if I work harder and I make more money, I just end up with more money. If I spend less, then I just spent less. But it's different with the government, right? If the government spends less, in other words, if we cancel Social Security, there's just an idea, every person has to save a whole lot more, otherwise they're going to be destitute. So when they save a whole lot more, they're going to spend a whole lot less. You're going to have a recession, and even though your debt went down, your GDP goes down more, and your debt to GDP gets worse. Likewise, if you want to increase your income, well, you can raise taxes through the roof, but then guess what happens? People have less money to spend, they spend less, you have a recession, debt falls, GDP falls more, debt to GDP gets even worse. There's a circularity there that doesn't exist with us. And so you really can't look at it through the same lens. Also, why am I not overly concerned about our debt levels right now? Because there's no freaking alternative. In the United States, our debt to GDP at 150% is lean and mean compared to the Europeans at 200% and the Japanese at 300%. There's only 3 risk-free bonds in the world: US Treasury, Japanese government bond, and the German Bund. And here's the real kicker. We do something insane that neither of them do. We actually pay you to lend us money. In Japan and Germany, you have to pay the government for the luxury of lending them money. So what else are you going to buy, folks? Every treasury auction is oversubscribed. And guess what? Everybody's worried about China. China owns 7% of our debt. I think my children own more than 7% of my money. They're not going to have a coup in this house. Now, Jerome Powell owns 40%. If he wants a coup, you got a problem. But I think we're safe with Powell. I don't think he's looking to overthrow anything. What's my point? My point is that it is correct to argue that we shouldn't look at debt through the lens of a household. It is correct to think that actually debt isn't quite as damaging as you would think. For example, and this goes all the way back to Alexander Hamilton at the founding of the Republic. If there was no debt, there'd be no US Treasuries. If there was no US Treasury, how do I price bonds? What's the right interest rate? What would you do? I don't know. I'd like having treasuries. Can't have treasuries with no debt, right? So I think all of those things are right. Where MMT goes off, in my mind, to a place that I'm not willing to go, is the idea that there's no particular limit, right? That you should be able to run deficits at whatever level, prevents inflation. Well, in a given year, that's right. But remember, debt accumulates. So at what point do you accumulate so much debt that if there is a new currency that rises or a new interest-bearing bond that arises, what do? The British didn't enter the 20th century with an empire on which the sun never set, expecting it to be gone in 50 years. And sure enough, it was. The other issue is that there's certain elements of MMT that in my mind are fundamentally undemocratic. So there's a belief that you need government spending to adjust instantaneously. So rather than have Congress pass things to increase or decrease spending, they want to create certain automatic spending programs. So the moment you lose a job, you get hired by the federal government. I don't think I want to do that, because if I can get $15 an hour and I can't be fired, will I really ever try to get 16 in the private sector? Is that worth it? If I get 15 for nothing, do I want 16 to do a crappy job that I don't like? What does that do to incentive structures? What does that do to communities? Does it hollow out communities that then are subsistence communities rather than communities that are building on their own successes? Do I like the idea that government spending is going to move automatically without a representative that theoretically is beholden to me making a decision on that? I think there's all kinds of problems with that. Is this something that is a grandchildren problem? No, it's a today problem. And it's not because it's going to explode debt to some number that we can't handle. Every time you have great technological change, and we've argued we're in a digital industrial revolution, you do have to democratize something, right? We democratized retirement savings through the pension and Social Security when we went from the farm to the factory. When we went from the factory to the office, we democratized healthcare through Medicare and homeownership through the 30-year fixed rate mortgage. I get that, but we've always done it in a way that preserved incentive, where people wanted to work and grow and do better. I think you can do that in other ways. So rather than going in the MMT style or the wealth tax style, you could do something like subsidized equity ownership, where if a company's above a certain size, they have to pay their employees with X percentage of stock. That's a way of helping people's wealth grow. You could have a sovereign wealth fund that takes your Social Security tax that today gets spent immediately, and you could try to grow it, having the Fed invested in a series of safe security. And there's all kinds of things that you can do rather than create automatic employment and running up debt through the roof that could come back to bite you. And so very much agree with the precepts behind it, very much disagree with a lot of the policy prescriptions generated from it. Frankly, though, the right's got to get its act together because they don't have any idea here. And the left is at least presenting an idea. I think it's a really bad one, personally, but it is an idea. And it's a base, and it forms the basis of an important and hopefully intelligent discussion. And I'll just say the final point is the old Winston Churchill line, and I believe this sincerely. You can always count on Americans to do the right thing once they've tried and entertained everything else. And I think this is one of those things that we will entertain before coming up with something better. But we are trying it in certain measure right now. And so this is a today issue, not a tomorrow issue.
Thanks. And Steve, what was the name of that book that you mentioned?
The Deficit Myth.
Okay.
Don't read it. It's bad for your health. I'm just kidding.
I know we're at 5 o'clock. If you have a few more minutes, I think we have two or three more questions. Okay.
Yeah. The only thing I've got after this is a glass of bourbon, so we're good.
Okay. Yeah, almost happy hour.
Yeah.
Deb, I think you have the next one.
Yeah, so you're mentioning spending and currency, a new currency. It was a nice segue into my question, which is about Bitcoin. And Bitcoin's been all over the news lately again. And can you give us your thoughts on currencies and how do you see this playing out over the next, say, 5 to 10 years?
Yeah, I think currency is a bad word for it. Right, a currency has to do two things. It needs to have a store of value. It needs to be a store of value, and it needs to be a medium of exchange. So store of value, think about it this way. Would you imagine, let's say you get paid a bonus on January 5th, and you need to make a down payment on a house on February 5th. Would you hold it in Bitcoin over that month? You can't. It could go up 50%, it could go down 50%. So it's not a store of value. Is it a medium of exchange? Well, you can't pay for your down payment at most places with Bitcoin. So it's really not a currency. It's really a commodity, right? It actually displays more, it displays more characteristics of a commodity in that it's volatile in its price, it has a limited supply, and most importantly, it generates no cash flow. So this is where this becomes difficult for somebody in my position. What investing is at its core, not trading, but investing, long-term investing, is projecting a cash flow and then figuring out what that cash flow is worth. So a bond throws off a coupon payment, every year, every month, or a couple times a year, and then you get a principal payment at the end. A stock generates an earnings or a dividend once a quarter. And so I can use my skills, theoretically, to understand those companies, understand those issuers, figure out what those streams are likely to be, how risky they are or not. And then I can take those and examine those against billions and billions of cash flow streams over time and today, and say, what has the market generally been willing to pay for a cash flow stream that looks like this? And it puts me in the position, hopefully, of being the casino and not the gambler. That I could lose big every once in a while, but the odds are going to be stacked in my favor, and I will rack up enough small wins over time that I can give a client a certainly better than coin flip chance that they're going to achieve their financial goals. Commodities have no cash flow. Gold pays doesn't pay you anything. Gold, oil, Bitcoin, which means that its price is solely determined by demand. What are people willing to pay for that commodity, for that rock, for that stone? Now, some of those stones and rocks have other uses. Some of them are industrial metals. Some of them are used in jewelry. Bitcoin is not used in either of those, so I can't look to that. So now I've got to look only at what people are willing to pay for. Here's the next problem. It hasn't existed that long. So I have no idea how it does in a high inflation environment. Why? There's never been Bitcoin in a high inflation environment. I have no idea how it does in a prolonged recession. There's never been Bitcoin in a prolonged recession. I don't know how it does in an environment where international stocks outperform, because they've never outperformed in its existence. There are, unlike gold or copper, some of these other commodities that have a very long-term history, I can't even try to understand how this acts in relation to other variables because its life is so short. So does that mean it's bad? No, it could be a great investment. Does that mean it's going to go down? No, it could quadruple. I have no idea. So I'm left as the gambler. I can't be the gambler with someone else's money. I can't do that. I've got to be the casino. So what do I do with that? Here's the advice that I give to people. Any dollar you put in it, you should be willing to lose and be willing to have it double. And you can't complain or cry either way. And it doubling doesn't mean you won't lose it all, and it going to zero won't mean it won't double after that. Nobody knows. It should be responsibly, if you're going to incorporate it, it should be incorporated in what is a majority, with the majority of your money run in a manner where the odds are more in your favor. So if you've got an overall asset allocation and that's all set and you're diversified and you've got a pool that you want to do with that, it's your money, right? You do whatever you want to do with it. But I can't put the odds in your favor with that instrument. And that's the challenge. And so people will make money on it. It won't be me. The other thing that I would say about it, though, is what shouldn't get lost in here is Bitcoin may be the pets.com of this generation. What do I mean by that? For those that don't remember, pets.com was really the first widely traded internet retailer. And people could see it and say, wow, internet retail is going to be a thing. And the only one you could buy was pets.com. So it went through the roof. Turned out pets.com was a kind of pretty crappy use of internet retail. There was going to be much better things that were going to come than pets.com. I think very similarly, the blockchain technology that underlies Bitcoin is as transformative as the internet itself. It has the ability to instantaneously verify online financial transactions in a way that requires no reconciliation. So if you make ice cream and you're shipping ice cream and you have a contract with the shipper that if the ice cream spoils, they need to pay you, today, that ice cream might have a sensor on it, right? The sensor may or may not ping me, but once it pings me, I've got to call the insurance company, file a claim, Maybe I need somebody to get sick. It could be months before I see a dollar. In a blockchain world, if it's set up correctly, that ping on the sensor of the ice cream will be instantly verified by a blockchain solution, which will guarantee with 100% authenticity that that ice cream did in fact spoil. It will automatically trigger a payment from the shipper to me, and I'll cut out everything in the middle. That's powerful technology. Right now, the only real investable manner of that is Bitcoin. I don't think it's the best one. I think it's the pets.com. Now, that being said, you'd asked me in 2000 if the online used bookseller was the messiah of online retail that we were expecting. I would have probably told you no there too. So you don't know which one's going to be the one. But I think those are all of the elements that are occurring around it. Last thing I'd say is this really kind of fits into the Reddit revolution. Look, there's a younger generation of clients that is telling us, it goes back into the ESG question. It's my money, and I want to be able to run it in a way that's consistent with my views, with my interests, and with certain asset classes that I want access to. We ignore that at our peril. It doesn't mean we should help people put together disastrous portfolios that are going to cost them all their money. That's the opposite of what we should do. But, and this is not the case at Raymond James, I know this is not the case with your firm, but there are a lot of firms where unless you have a ridiculously high amount of assets, even getting a financial advisor is impossible. Nonetheless, one that's willing to incorporate active management, and certainly not one that's willing to carve out a portion of your money to invest in a theme that you're interested in. I think that's a mistake. I think we need to do a better job of servicing the needs of all wealth management clients, even the smaller dollar ones, because they're going to inherit a ton of money and they're going to earn money, and it's their money.
Thanks, Steve. That was perhaps the best explanation of Bitcoin and just how that all fits together I've heard. So thank you.
Thank you.
Yeah. Got a question. This is another one from one of our clients.
Yeah.
The market is stoked right now in part because of the vaccine and the expectation that we'll be returning to some level of.
Did we use the word stoked in the email?
Yep,
that's awesome. All right, keep going. Sorry.
Some people are really worried that the virus mutations will seriously affect this expectation that we're getting back to normal sometime later this year. So do you see that having an impact on the markets?
No, but yes. Mutations are normal. Mutations occur along the protein. We haven't talked about mutations. Sure. Yeah. Okay. So all viruses mutate. All viruses mutate. They mutate like any other creature does through evolution in order to survive, right? That's why organisms mutate. So what is a successful virus? The most successful virus you can think of is the cold. Why? Highly infectious and not deadly. If it's deadly, it doesn't work. It can't spread as fast. A dead person doesn't come into as much contact as a live person. So viruses that tend to be very, very deadly fizzle out. Ebola was big, but it didn't have the kind of spread around the world that COVID has had. So viruses tend to become less deadly, but more infectious. Well, by the way, a non-deadly, highly infectious virus is called the cold. We've lived with that before. So that's one thing. The second thing is to remember the nature of the vaccine that we have. And when I say we, I'm specifically talking about the United States. The Moderna and the the Moderna and the Pfizer vaccines are not traditional vaccines. A traditional vaccine, AstraZeneca, Novavax, and Johnson & Johnson, you take the virus, an inactive or dead form of it, or weak form, you inject it into somebody's body, and you let them respond to it and create antibodies. That is not at all what the Pfizer and the Moderna vaccines are. They are a piece of genetic code. That genetic code is inserted into your body, and it tells your cells, you find anything that looks like a crown and you kill it with extreme prejudice. Now, why does that matter for mutations? Because your cells don't give a damn after it gets that code if the crown has a jewel on the left or a right, or if it's a purple jewel or a green jewel, or the spikes are on the side, or it's velvet wrapped. Damn it, if it sees a crown, it's going to kill it. That's why when you look at the traditional vaccines, Novavax, Johnson & Johnson, and AstraZeneca, they go from 85 to 90% effective against the standard COVID, but on a South African variant may go all the way down to 60%. For Moderna's vaccine, it goes from 95 standard to 92 on South Africa. And they've already developed a booster to kind of get it back up that should be forthcoming soon. So I'm not of the belief that there's some massive mutation here that makes these vaccines ineffective. And all of the vaccine companies and the health officials have confirmed that. Now, what's important though, is we don't want to invite more mutation than is necessary. Viruses mutate when they spread. So if you have uncontrollable spread, they have more opportunities to mutate, and you could come up with something that's maybe a little bit more troublesome. So we're like at the end of the tunnel. Let's not screw this thing up before we like close the door on the barn. It'd be really stupid to do that right now. So yeah, last year has sucked. It sucks even more now. Let's let it suck for another 3 months and then we're done. So let's not be dumb in the meantime. I think that's one element. The second element is what I expect will most likely be the case is the virus will spread enough over the next couple of years that we'll need a shot every year, right? But then, because fewer and fewer people are able to get it, the virus has fewer opportunities to spread, therefore fewer opportunities to mutate. Eventually, you won't have to do that anymore. I think that's probably the most likely case going forward. I think the bigger problem is I think there's some people that don't want this to end completely. Not that they don't want it to end. They don't want people to die in sickness. But I think that, and this is going to be a bigger tension and a policy question, I think there's a lot of people, and I include myself to a certain regard here, that maybe there's elements of this life that are a little bit better than exactly what was going on beforehand. And so I think that you may see more hysteria around, some of the variants than is necessary. So yeah, we could go back, but my gosh, we got to watch out for that, I don't know, emerging Norway strain, maybe we need to stay home a little longer. I think you could see some of that. But I think the idea that I just understand this, and I believe this, as bad and terrible as this virus is, the most vicious creature, most vicious, cruel, adaptable, deadly, murderous creature in the history of this universe is us. We can adapt faster, we're meaner, we will kill it before it kills us. It doesn't stand a chance, nor has any other organism that's ever gotten in our way. And so I don't expect this is going to be any different. We will beat this thing. The question is will we have frictions about how we want to go back and what parts of society we want to keep different and which parts we want to go back. And I think that's going to be a negotiation process, which could cause certain pockets of economic activity to slow. So for example, if teachers don't want to go back in the fall, even if, and I'm not saying that they do or they don't, I'm just using that as an example. If there are teachers who don't want to go back in the fall, even after vaccination, then there's a lot of people that can't go back to work. So it won't matter if it's the virus or not, right? So those are, I think, some of the larger policy questions that we need to answer. But that's not about the virus.
Great, thank you, Steve. And I think we have our last question from Brian, and we'll wrap this up.
Yeah, listen, we've talked a lot about a lot of great things, a lot of great answers, but sometimes you just don't know what you don't know, right? Yeah. So I'm curious from your perspective, what's the one thing that no one's talking about right now that's either got you most excited or most concerned? The one thing that no one mentions that might wind up being way more influential than we think it should be, or that anyone thought.
So I'd like to be a smart aleck and answer that with I don't know, but I guess that wouldn't be an acceptable answer.
It's a fair answer, but
no,
maybe look for something else,
So I'll answer it in a couple of ways. It's never the last thing. Let me start there. We have there's a tendency each time you have a problem to set up if you've ever heard of the Maginot Line, right? The Maginot Line, anyway, I won't go into the story, but anyway, we have a tendency to look at the last problem and create an ironclad solution to ensure that the last problem never happens again, and it leaves us completely open to the next problem. So it's not going to be the last problem. I know that. In terms of, what are some of the things that could come? Inflation could theoretically surprise. I don't think it will, but it could. I think we don't quite understand the consequences of stimulating the way that we have. And I don't mean from a debt perspective. One of the things that happened after the great financial crisis is because we didn't stimulate all that hard, and we went to austerity pretty quickly in 2010 with government spending cuts and tax increases. You had a very slow recovery, which meant rates stayed very low for a very long period of time. And that ended up being a very good environment for the equity market to create a very long economic cycle. So the question is now, if we stimulate very hard at the beginning of a recovery, do we then create more robust economic growth that then creates a shorter cycle? So does the Fed have to normalize starting in 22 and 23 rather than, 3 years after the fact rather than 8 years after the fact? Now, is that good or bad? Well, it's good if you want to get a job. It's bad if you want economic growth to be slow, rates to stay low, and markets to grind up for 10 years in a very low volatility way. So I think that that's something that we don't quite understand yet. I think ultimately, though, I'll answer it this way. I think it's almost the wrong question. We spend a lot of time worrying about what's going to go wrong. I don't think we spend enough time worrying about what's going to go right. Here's what I mean by that. There is a behavioral perception that the optimist is naive, whistling past the graveyard and fattening themselves up for the slaughter. And that the pessimist, who squirrels away for the rainy day is wise and thoughtful and not to be fooled. That would be true if the long-term trend of markets didn't look like this. If prices didn't rise on average by 10% a year from the beginning of time until now. It would be true if the arc of history wasn't generally one of progress. When you enter that into the equation, then the story becomes quite different. The person who predicts the end of the world is the most arrogant son of a gun you'll ever meet. They believe that they're going to be the first person that was ever right in that prediction. The person who believes that the sun is going to rise has billions of years of sunrises supporting their prediction. They're not bold. They're not naive. They're just saying that that which has existed from the beginning of time until now is likely to exist tomorrow. Isn't that a better bet? And so for all the ink that we spill over what's going to go wrong next, nobody died being down 40% in 2019 or 35% last year. You died by not being up 100% since. That if you are the casino, right? The casino's job is to make sure that the odds are stacked in your favor, not trying to worry about the one guy that's going to beat you at blackjack. Yeah, you're going to get beat at blackjack once in a while, or somebody's going to pull the lever, and guess what's going to happen? You're going to have to pay out $1 million. You're going to have a decline. It's going to happen. But as long as the odds are stacked in your favor, that prices are going to go higher, you should be levered to that. Because here's the dirty secret. If you had enough money, you wouldn't have invested in the first place. The reason why we invest is we don't have enough money. If we had enough money to fund all of our goals, all of our spending, all of our retirement, all of our giving, and all of our inheritance, why the heck would you risk it? Just count it, swim in it like Scrooge McDuck. But you don't, so you need it to grow. So you put it at risk, knowing that as long as we have babies and invent new things, prices are going to go higher. So stick to that and figure out how you're going to get yourself in a mindset where you're not going to freak out when the next unknown comes. So you don't do something stupid like compound a pandemic that cost people their lives by panicking at the bottom and selling and costing yourself your financial goals. Because again, 2 clients, they both invested in the market 12/31/1929. One of them did nothing for 90 years. The other one bought $1,000 a month because they were an optimist. If you did nothing, you earned 13,000% over 90 years. If you bought $1,000 a month, you earned 82,000%. And you outperformed in the 30s, the 40s, the 50s, the 60s, the 70s, the 80s, the 90s, and the 2010s. 8 out of 9 decades. And by the way, in that period, you experienced a world war, a depression, banks closing down, inflation, Woodstock, Richard Nixon, inflation, baby boomers, Coldplay, Reddit. And so I think that is, as much as there's that built-in mental desire not to be fooled and get caught, Just figure out how you're going to deal with the next time the market drops so you don't do something stupid. If you took out a credit card today that compounded interest at 8% a year and you never paid off the balance, you would know with 100% certainty in 30 years that you would be broke. So if I'm telling you that you've got an instrument that has compounded a return at 8% a year through all of history, then why don't you believe you're going to be rich? You're going to be. Just don't get out. And I know that a lot of investors don't like to say that on my side, because if the answer is that simple, then what do you need me for? Well, the reason you need me is because we're all humans and we all panic and we all freak out. And so we need to analyze things to be comfortable. But the story here is just don't panic. Doesn't matter what the next problem is. The question is how you're going to stay in, how are you going to buy it, and how are you going to take advantage of the fact that we're going to continue to invent things and have babies. As long as those are in play, the risk is to the upside. I know that sounds simple. I know it sounds naive, but I got history on my side, so I'll take my shot.
All right. I think that's a great place to end. So thank you, Steve. Thanks for your thoughtful, easy to understand responses. Thanks for the entertainment. That was a great way to spend an hour and 20 minutes or so. So
You're in my bourbon?
Yep, you earned the
All right,
bourbon,
good.
absolutely. So, and thanks to everyone for tuning in. We appreciate you doing this with us, and hope you found it to be helpful, and hope you learned a thing or two. And if you have any questions or anything that you want to talk about more, just reach out and give us a call.